Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Lyn Alden from Lyn Alden Investment Strategy. So thank you so much for being here.
Hey, thanks for having me.
So Lyn, could you tell the audience a little bit about how you got into the finance business and your journey to Wall Street and how you got to where you are today?
So I started investing as a pretty young age, but when I went to university, I studied engineering instead. So I kind of took a hiatus from my passion in investing. I focused on engineering, but when we had the global financial crisis, in 2008, 2009, so back in 2009, stocks got very, very cheap, and so that made me, kind of re-energize me towards equities again, and so that kind of gave me a sharp push back into it. And I started writing about it. And then, in the past 4 to 5 years, I increasingly focused on providing professional research in that area. So it's kind of bringing that kind of quantitative background from engineering into the investment realm.
And you describe your strategy as value investing with a global macro overlay. So could you describe what that exactly means?
So I take both a bottom-up and a top-down approach to investing. So some investors focus on stock picking. They ignore what's happening on the macro scale, and they focus on what individual companies are doing. Other investors like to focus on what's happening at a high level, and they don't go down to individual companies. They use ETFs or other sort of assets to express their view. One thing I do is my investing journey started with individual companies, and so I still stick to that. I still look at individual companies. But then I also look at the broad macro picture as it relates to monetary policy, fiscal policy, broad valuations between different types of markets to give me kind of a broader sense of what sort of companies I want to be looking at or what kind of weights I want to have towards different asset classes. So it's kind of that marriage of
Right.
high level investing and the bottom up investing.
Right. So I wanted to kick it off with asking you about sort of your dollar thesis. And could you describe your dollar thesis, how we see inflation, and why you're long-term bearish on the US dollar?
Yeah, so ever since the global financial system shifted toward floating exchange rates in the early 1970s, so we've had about a 50-year period of this floating exchange rate regime. Before then, the dollar was pegged to gold and many other currencies were pegged to the dollar. But in this past 50 years or so, we've had floating exchange rates. And during that time, the dollar's had three really, really big cycles that last on average like 15, 16, 17 years. And so the first big dollar spike relative to a basket of foreign currencies was in the mid 1980s. Then it fell. Then the second big dollar spike was in the late 90s, early 2000s, and then that fell. And then the third big dollar spike has been ever since the end of 2014, the beginning of 2015. We've been in a strong dollar environment since then. And these big shifts tend to happen based on Fed shifting from very tight fiscal monetary policy to very loose monetary policy. And there are some assets that are very sensitive to this. So for example, emerging markets are the most sensitive to this for a variety of reasons. They often have a lot of dollar denominated debt. So they owe, companies and governments outside of the United States often borrow in dollars and therefore owe dollars. And so, but they have a much harder time getting dollars to service those debts compared to companies inside the United States. And so you tend to see more issues with emerging markets when you have a very strong dollar. And so ever since late 2019, I've shifted towards a bearish dollar view. And that's because the Federal Reserve was forced to shift from very tight monetary policy to very loose monetary policy for a variety of reasons. And so now, I expect that we're probably on a down leg of this very long-term dollar cycle.
And I wanted to ask you, your current sort of macro inflation thesis versus Dr. Lisi Hunt, who's a long-term bond bull, and he's talked about how the 30-year Treasury is actually going to go down to 50 basis points. Well, and he argues that that we don't have the mechanism to inflate until we actually rewrite the Federal Reserve Act. So what exactly do you say to that?
So, I mean, I think there's an outlook that can certainly happen. If they don't do a lot of fiscal spending, I can certainly see a possibility where the very long duration bonds get down to 0.5%. It's certainly possible. I think one way that I differ from that view, and I've had some discussions or debates with people that hold that kind of outlook. And what I would emphasize is that when you have very large fiscal deficits, and then the central bank buying a very large percentage of the treasuries that are used to fund those deficits, that is essentially going around parts of the Federal Reserve Act without actually violating it. And so that's kind of been a point of contention. And so I would point to various times in history, like especially the 1940s, where they were able to generate a lot of inflation with the combination of large fiscal spending and that monetary debt monetization without changing the Federal Reserve Act. And so basically my view is that as long as there's going to be very large deficits with monetization, the probability is towards higher inflation. Now, where I would shift towards that more disinflationary view is if they were to close the deficit gap and kind of shift to a more financially austere situation. Then I think that more deflationary outlook could play out.
So, well, one of the things that a lot of people mention when they talk about deflation is the fact that right now the economy is sort of in shambles. We saw a massive spike in weekly jobless claims last week. Last week, we also saw a massive build in oil, and today we saw retail sales go down. And one of the things, sort of the milkshake theorists talk about is the fact that in March, a lot of people were forced to sell treasuries, sell everything in order to get liquidity, and that spiked the dollar up. And what they say is that the next time this happens, it's not going to be sort of a liquidity event. It's going to be sort of an insolvency event where where the Federal Reserve will not be able to step in and solve that problem. So, what do you say to that?
So I think you have to separate domestic situations from the foreign situation. So one thing about the domestic situation is, so for people that were looking for a strong dollar, we got that dollar spike in March, as you pointed out. Now, it wasn't because foreigners were selling treasuries. In fact, the strong dollar is what made foreigners sell treasuries because they needed to get dollars. But then that set off a chain reaction where, in order to prevent the treasury market from crashing and becoming a liquid like it was, the Federal Reserve had to step in, buy a lot of treasuries, and basically reliquify the market with I'm focusing on is
Could you
that
say
you
that
have that
again? I think I lost you. Could you say that again?
sure. Where should I start? Like at the beginning of that?
Yeah, sure.
Okay. So what we saw in March, I think, is you have to separate the foreign situation from the domestic situation. So, back in March, we had that strong dollar spike, and that's because, there's a variety of reasons. Global trade collapsed, commodity prices collapsed. And so a lot of that dollar-denominated debt outside of the country suddenly started, scrambling to get dollars in order to service those debts. And so foreigners had to sell treasuries, which didn't cause the dollar spike, but it was because of the dollar spike. In order to get dollars to service those debts, they had to sell some treasuries. But that set off a chain reaction because then you got the freezing of the treasury market, you got a spike in yields, and so the Fed had to come in and buy $1 trillion worth of treasuries in 3 weeks and basically re-liquefy that market with a lot of new dollars. So if you were to see another dollar spike, you probably have a similar reaction by the Fed. Now, it is true that the Fed alone cannot fix solvency issues. They can only fix liquidity issues like that. But that's where fiscal spending can potentially address solvency issues because, unlike the Fed, they can literally just hand out money to people, to businesses, with no obligation to pay it back. Like either, people don't have to pay back the stimulus checks. Most of the PPP loans that turn into grants are just going to be forgiven. Essentially, they're not really paid back, and so. But that the Fed and the fiscal situation can't bail out really kind of foreign entities. So you will have defaults in certain companies, certain countries that are over leveraged. But basically, whenever it gets bad enough that you have a sell-off in the treasury market, that's when you have a lot of rapid new dollar creation to offset that. So I think it's always important to keep in mind both the liquidity and solvency issues, but then also the necessary feedback loop that happens if you get a freeze up in the treasury market.
Right, and when you say that the Federal Reserve actually creates new dollars, uh, you know, uh, those dollars actually tend to be bank reserves, which is what the Fed actually considers to be new money printing. And a lot of people disagree that that is actually the creation of new money. So, to what extent do you agree or disagree with that?
So it depends on the specifics. So because I think a lot of them, they get their view from what happened about 10 years ago during the global financial crisis. And it's true that, when the Federal Reserve creates bank reserves, that by itself does not get that money out into the broad money supply. So we can think of bank reserves as like wholesale money. That's money that the banks have on deposit at the Fed. Whereas consumer money is like money that you and I have. It's money in our checking accounts, savings accounts, money markets accounts, things like that, that we actually, that consumers and businesses actually use as money. And so if you look at what happened during the period from 2008 to 2014, when the Federal Reserve did a series of quantitative easing programs to recapitalizing banks. And so banks were recapitalized, but it didn't get out to the broad money supply because banks didn't lend it. It therefore, those dollars didn't get outside of that system. Now, what was different in 2020 is that the government ran absolutely massive deficits, and then a lot of those treasuries were monetized by the Federal Reserve. And so you had an increase in bank reserves, but then you also had an equal increase in broad money supply. And because the fiscal spending can go around the bank lending channel, and ironically, if you look back in history, the biggest increases in broad money supply happen when banks aren't lending because the system freezes up and then the government just goes around that channel and basically just injects money into businesses and to people, whatever it's trying to do. And so I think that's one thing to focus on is the combination of the QE alone is different than the combination of fiscal spending plus QE. And I think that's kind of a roadmap to have as we go forward in the 2020s and how it could be different than the 2010s.
I want to stick with the dollar for another minute. So right now the dollar as the reserve currency, due to the Triffin's dilemma, they have to run a trade deficit in order to export dollars to the world. So what is the probable final outcome or end of the currently necessary U.S. trade deficit?
So there's a gradual outcome, and then there are potentially more sharp outcomes. And so the gradual outcome is that you can see some other countries beginning to go around the dollar when it comes to pricing energy. And so basically the way that the global reserve currency works in the current iteration since the 1970s is something we can call the petrodollar system, which is that almost all oil producers in the world have agreed for decades to only sell their oil in dollars. And so, for example, if France wants to buy oil from Saudi Arabia, they have to buy it in dollars, even though neither France nor Saudi Arabia use the dollar for their own domestic currencies. And so that's what gives the dollar its true global reserve status. And then so other oil importers, they often sell their products in dollars because they can get dollars to buy oil. And that's what keeps dollars circulating around the world. And so, but that also ends up meaning that in order to supply the world with dollars, the United States ends up being forced to run these big persistent trade deficits. So we kind of export our manufacturing chains. We kind of really hurt our blue collar workers in order to kind of maintain that system and maintain that dollar hegemony. Now, there's a couple ways it can end. One is that we're already starting to see some countries go around the petrodollar system. So, for example, Russia over the past several years has begun pricing oil in euros more so than dollars, and so that kind of chips away at the petrodollar system. Now, if you do see other oil producers do that, whether it's Saudi Arabia or some of these others, if you see more diversification in there, then you can kind of move away from this very dollar-centric system, and the U.S. trade deficit could be currency devaluation or other things that could potentially close the trade gap over time. But those would be kind of shocks to the system. Those would be unexpected things that are not currently, kind of priced in by most market participants. So there's kind of that slow option, or
Right.
there's that kind of surprise option.
A lot of people have sort of a misconception that that being the world's reserve currency is sort of a good thing. So is that a good thing or a bad thing? And could you explain sort of the mechanics of that? Is it like a burden or is it a benefit?
So it depends on who you are and when. So when this was set up, it gave the United States a lot of power, especially because back when this was set up, it started after World War II, right? So the Bretton Woods system, the gold-backed standard, that was built in the final year or so of World War II, and then the most recent system, this petrodollar system, that was initiated in the early to mid 1970s, and that was during the Cold War, right? So that it basically gave the United States a lot of influence around the world and increased our military reach, increased our geopolitical reach. But basically, the sacrifice we had to make was that we had to begin exporting our domestic manufacturing chains more so than other developed markets did. So on average, a lot of manufacturing has shifted from developed world to emerging world, but it's happened more quickly in the United States, whereas you haven't seen nearly that degree happen in, say, Japan or Germany or these other kind of, advanced manufacturing hubs. And that's because of how we've structured our system. And so it's been very detrimental to blue collar American workers, all sorts of skilled craftsmen, of people that make things. And it's been very beneficial towards Wall Street, people that work near DC, people that work in technology or healthcare, because we've gotten a lot of the benefits of the system without really, having our incomes impacted or our jobs exported. In addition, now as this goes further and further, that kind of becomes systemic. Now we have rising populist politics. We have kind of more domestic instability due to having this policy in place for several decades. And so basically, to answer your question, it was beneficial in the beginning, and it got less beneficial over time. It became more of a burden. And then during that time frame, it was more beneficial to people that are kind of at the top of the income ladder, and less beneficial, even kind of from the beginning, of people that are lower on the income ladder.
Got it. I want to move to more of the macroeconomy than just focusing on the dollar. So, what is one thing that you fear the most, sort of next year, which could upset the apple cart, or so to speak?
Well, I think, I mean, there are always tail risks, right? Any sort of unexpected military action obviously would be massive. We have to watch the ongoing relationship between the United States and China, as well as the United States and Russia. Both the United States and in some other countries, is the destruction of small businesses. And so, for example, countless restaurants and other small businesses have had to close this year, partially due to lockdowns, partially due to shifting consumer behavior around the virus, while at the same time, large companies were able to stay open, they're able to access capital markets and get cheap capital. And so we've really had this bifurcation between, kind of Main Street and Wall Street. And so I think that's the biggest concern, is that when you have that sort of destruction in all these smaller businesses, that can create a lot of unrest over time, especially as the full effects of that play out, as the solvency issues, as you before mentioned, as that fully runs its course in 2021. I think that's going to put a lot of pressure on policymakers to address that, and just because it's been so devastating to a lot of people.
And with Biden winning the election, there's bound to be sort of a shift in fiscal policy as well as in monetary policy. So, do you see any changes uh, to monetary policy specifically? And do you think sort of Jay Powell is still going to have a job?
So Powell's term, I believe, that goes through 2022, and we'll see what happens from there. It's possible that he'll be replaced. It's possible that he won't be. Um, uh, if he were to be replaced, there's some candidates like Brainerd that are somewhat, they lean more dovish. So I don't think there's a lot of impacts in the near term on monetary policy. For fiscal policy, there is potentially more of an impact. There are a couple key variables to look at. One is, we have to see the results of the Georgia runoff Senate elections, because we still don't know the makeup of the Senate. So if the Senate ends up being in Republican control, then we're probably not going to see a very large difference in fiscal policy, just because the Biden administration would have to agree with the Republican side, the Republican controlled Senate, on anything that gets through. And so you don't really have those more extreme outcomes. Now, if you get a blue control of the Senate, then you could see more aggressive fiscal spending, but potentially also offset by higher taxes on some companies or some income groups. And so I think it's really going to hinge in part on what happens with these Georgia elections.
And there's this massive risk of mass evictions as soon as next year if Congress don't pass anything. Is that something you're watching, or do you think that's sort of low probability? Do you think that we're going to see a stimulus deal by Christmas?
So that's part of the small business destruction thing, right? Because it all plays into the same theme of everyday people that were heavily impacted, sometimes because of government action, like saying you can't open your business or you can't do this, but then that's their livelihood. And so it looks like they're coming together for a deal around, before Christmas time or around Christmas time. So I think as a base case, we're likely to see something like a $900 billion issues play out more problematically.
If you could go back and undo one thing that the Federal Reserve has done, what would it be? And it's always interesting to see what could have been done in hindsight. So, what is something that you would do differently if you were the chairwoman of the Fed?
So I don't particularly agree with the Fed's corporate bond buying purchases. So I think that's been one of the more problematic areas of policy, just because that favors larger companies that can access capital markets versus smaller private businesses, right? So if you have a large restaurant, and they're issuing bonds to fund their operation, the Fed is basically helping, through forward guidance and purchases, they're helping to keep those yields down. Whereas like a small family restaurant that doesn't access capital markets, they're not getting any help from that. And so I think that that policy towards interacting in private bond markets was just not very well advised.
As a bottom-up investor, where exactly do you see asset bubbles right now, and what are some areas of the economy that you would want to avoid from an investment standpoint?
I'm viewing a lot of U.S. tech stocks as overvalued at the moment. So companies like Apple, some of these electric vehicle makers, or some of the companies that are involved in renewable energy. A lot of things, if you look at their fundamentals, they haven't really changed much this year, but their stock prices, in many cases, doubled, tripled, quadrupled. And that's there's a variety of reasons for that. Partially, it's low interest rates, so investors piled into these higher growth tech stocks. But as that unwinds, if we do get some higher yields or a little bit of a rebound in inflation, that can put a lot of pressure on those very expensive tech stocks. And that also applies to some non-tech stocks, like for example, Costco is, it's not a tech stock, but it's kind of a growth-oriented stock. And it kind of has similar themes where it's become quite expensive. And so I think that, investors have paid up handsomely for companies that are not very cyclical or that are tech-oriented. And that has a risk of unwinding, if we get any sort of reflation trade, any sort of shift to value, shift to higher rates. So I think that's an area that's pretty concerning.
What are your thoughts on emerging markets right now compared to the US? I believe during your interview with Brent Johnson, which was, I believe, a few months ago, you talked about how there's sort of a difference between a solvency crisis and a liquidity crisis outside the US. And you pointed to countries like Turkey and Argentina as being part of the solvency group where they would face a solvency issue. And we've seen the Turkish lira depreciate a lot over the last few months. And we've also seen um, and you've also mentioned that a lot of countries own a lot of USD assets, which they can sell off to pay or to raise US dollars. So, how exactly do you view emerging markets right now?
Can you repeat that? I think we got cut off again. You said I also mentioned that, and then you froze.
You also mentioned that you also mentioned sort of a difference between um, the solvency between insolvencies and a liquidity, especially outside the US, where you pointed to countries like Turkey and Argentina as saying that they would face insolvencies, and we've seen the Turkish lira depreciate a lot versus other countries which could just sell off US assets, USD assets, and raise US dollars. So, what are your views on emerging markets right now, especially with your longer term bearish US dollar outlook?
So I remain favorable towards emerging markets in general. That was, like you said, that was a view I was expressing a lot this summer. We've since had a pretty strong move in a lot of emerging markets, and so I wouldn't be surprised to see some degree of correction in the near term. I mean, whenever something comes pretty far, pretty fast, it's always likely to have some sort of a kind of a cooling off period. But overall, as we look out, say the next 5 years, I think a lot of emerging markets look pretty favorable, especially if we do get this weaker dollar move. So in general, their valuations are more attractive than U.S. equities, and they have a lot of that exposure to more of the value side of things. And even if you look at, say, Chinese tech stocks, they have generally better valuation characteristics than some of the U.S. tech stocks. And so, but as you pointed out, it's good to separate the ones that have a lot of strength back in their currencies. And so most of them have pretty high foreign exchange reserves relative to their dollar denominated debts. But then there have been some problematic areas like Argentina and Turkey that have very little foreign exchange reserves relative to their dollar-based debts. And there are a variety of others like Lebanon, or to a lesser extent Chile, that are somewhat more risk for these sort of things. But some of the ones like that have just like Malaysia, for example, or Russia, that don't really have that solvency issue, I think are pretty interesting opportunities.
Got it. No, one of the things I've never really heard you talk about was more of your bottom up approach. You've talked a lot about your top down approach. I'm just curious. So, what exactly do you look for in companies before you invest in them from a bottom up standpoint?
So it depends on the type of company. I mean, for most sort of businesses, I look for a wide moat business. So something that has, an inbuilt defense against competitors that allows it to earn high returns on invested capital for a sustained period of time. And then apart from that, I look at valuation, right? So I look at things like not just price to earnings ratio, but also things like price to earnings to growth ratio, like so the PEG ratio, or how their dividend yield compares to how it historically once looked. I looked at balance sheets, especially debt to income, price to earnings to growth ratio, so the PEG ratio. So that compares valuations in the present compared to forward growth expectations. And so I kind of, I emphasize a lot of growth at a reasonable price stocks. I look at some deep value stocks. And so anything that basically has a really wide economic moat that's also trading at a pretty reasonable valuation, and that just kind of is it a good position to compound capital for the next 5 to 10 years, are companies that I like to include. Now, there are also like resource businesses that have to be valued a little bit differently, right? Because they're not wide moat businesses, but because of the cyclicality of the industry, they can have really explosive gains if you take into account that macro situation. So when I look at those companies, I tend to err on the side of being more conservative. So I look at ones with stronger balance sheets, low cost production, high quality management that can get through the challenging cycles in resource commodity prices, even if they aren't quite as explosive during the bullish phase of that cycle, but that do very, very well over a multi-cycle time period.
What are some specific industries and sectors that you're bullish on right now?
So it's tricky because we've already had a lot of moves. So if you would have asked me a few months ago, I would have pounded the table on energy, commodities. We've had a really strong kind of uptick in some of those areas. Now I still think that high quality energy companies are probably well positioned for the next several years. But I wouldn't be surprised to see turbulence over the next 3 to 6 months as some of these previously mentioned solvency events or other problems play out. But I think for investors that want to position for the long term, some of the ones with the strong balance sheets, low cost production, or that focus just on transporting energy, right? So they're less sensitive to commodity prices. I think those sort of businesses could do pretty well. I've also been bullish on uranium since the summer, and just overall, I think there are a lot of opportunities out there. I also think, as an asymmetrical bet, a small Bitcoin position is also looking pretty good for 2021. I've been bullish on that since April of this year, and it's already done well. But I still think that it can do pretty well in 2021 as well.
Could you describe more of your uranium thesis? I'm just curious to hear what you have to say.
Yeah, so with uranium, we often we focus on the fact that a lot of Western countries and Japan have reduced their reactor fleets, right? So it's not really the growth industry that it once was. However, if you look over in Asia, China's building nuclear reactors, India's building nuclear reactors, South Korea's building nuclear reactors. Some of the Middle Eastern countries are, some of the Eastern European countries are, and there's a variety of reasons for that. So many of them still heavily use coal and are still.
Hello? I think you broke off.
Yeah, I think yeah. I don't know if it's on my side or your side. I haven't had this problem
Yeah, me
recently.
neither, actually. Yeah, you're talking about Asian countries using coal, so yeah.
Oh yeah, so Asian countries are actually still growing their coal usage. They, if you look at, say, the electrical grids of China or India, they use a lot of coal and are still growing their coal usage. Whereas in Western world, they've kind of dialed back their coal usage, and so that creates all sort of air quality problems. And so one of the ways that they can have more, cleaner energy is to go with the nuclear route. And they have been doing that. And the way that nuclear reactors, work is it's kind of like air travel, right? So air travel is super safe, but every once in a while something goes horribly wrong, and that's what all the media focuses on, even though on average flying is safer than driving. And nuclear is kind of the same way, where it's over the lifetime of say the past 50 years, nuclear energy has been safer for people than, say, coal usage, right? So if you count all the deaths based on coal mining or pollution from coal, it's far higher than nuclear energy. But every decade or so, we get a nuclear disaster, especially they were all from that older tech. So even the 2011 disaster, that was based on a reactor that was built in the 60s or 70s. And so have been advancements in them to make them safer. And so we have been seeing interest out of Asia in terms of building more nuclear plants. And then in addition, just to maintain existing plants in the Western world, uranium basically has to go up in price in order to get more production to come online. And because uranium is currently below the cost of profitable production, at least for most companies. And so as we look out over the next 5 years or so, there's a pretty high probability to see uranium do pretty well. Now, we've already had kind of a sharp move in the past couple months, so the
Right.
thesis already started playing out. So again, if you would have asked me, say 2 months ago, I would have been more bullish than I am now. But I still think this is a multi-year story, right? So it's kind of any sort of value investor has that double-edged sword where something does well initially, and you're almost disappointed because you wanted to buy more, or you wanted, but I still think that even though this sharp move happened, I still think there's a pretty good runway ahead for uranium stocks.
Got it. I want to wrap up the podcast by asking you, um, would you equate sort of digital money printing or digital currency issuance to the issuance of money in countries like Venezuela or Zimbabwe? And in your opinion, what is sort of the right time horizon or realistic time horizon for digital currencies and government issued digital currencies to play out and get into the mainstream?
So some of those countries that experienced hyperinflation, like Zimbabwe or Venezuela, there are a couple of factors that go into that. So often, emerging markets that experience that problem, it's often because they're live. I think we froze again.
Yeah.
Okay, I'll start over. Yeah, it's gonna be hard for you to edit this. um, so if we look at countries like Venezuela or Zimbabwe that experienced hyperinflation, or even if you look at countries like Argentina that have experienced not quite hyperinflation but very high inflation, there's often a couple things involved. One is they often owe liabilities in something that they can't print, like dollars, for example. It's not their own currency, and so that's more likely to lead to high degrees of inflation and outright defaults. Secondly, when you look at the Weimar Republic or Venezuela or Zimbabwe, you often have some sort of failed governance or lost war, or whatever the case may be, that destroys national production. And so you get that, you still have all those obligations, but you lost production that allows you to support all the things your economy needs. And so that's when you tend to get that hyperinflationary outcome. Now, with developed markets like the United States or Canada or Europe or Japan, they most of their obligations are in their own currency, and they've maintained pretty good production. And so you're unlikely to see those hyperinflation outcomes. But as we saw from the 1940s or the 1970s, you can still see pretty significant inflation if you were to get the right mix of monetary policy, fiscal policy, and then perhaps some things like commodity shortages or other things like that. And so I think it's important to separate, how emerging markets experience inflation versus how it can arrive in developed markets. And then as far as central bank digital currencies, that opens up a variety of new tools for them to potentially trigger inflation, because central bank, I mean, they literally want inflation. They literally
Right.
want higher than 2% inflation. And so that can potentially increase monetary velocity. It can potentially kind of more blend fiscal policy with monetary policy by going around the banking system and getting money into the hands of people.
Right.
It can do things like behavioral economics, like give people stimulus checks that have to be spent within the next 3 months rather than saved, or they expire, for example. It can be, you can have interest rates on different groups. Like you could have higher interest rates for lower income people and less interest rates for higher income people. There's all sorts of different things they can do, but of course that sacrifices policy privacy, right? So
Right.
so it's one of those things you can see why the central bankers would want it, but you can also see why people wouldn't want it opposed on them. And so we'll see how that develops. It's already rolling out in places like China, whereas for example the United States is not really they're pretty far behind on that because the United States is the center of the current system, so they have less incentive to try to change things, whereas some of these other countries that are not thrilled with the way the current system is structured, like China, have been more, willing to go around it.
Got it. Thank you so much for being on the podcast.
I think we froze again.
Thank you so much for being on the podcast.
Yep, thanks for having me.